Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at a follow up to a recent trade idea we kind of put out there in early March, March 4th. It came out on volatility means opportunity in the South Korea ETF EWY, where some big, unusual option activity, especially on the call side, set up ideally for a vol capture trade to basically play for that huge spike in IV to come back to some semblance of sanity. So let's jump in and take a look, shall we? First of all, here is the original trade, as I said. A quick recap. You can look at the previous video from March 4th, but EWY, as you can see, had over 350,000 contracts traded versus less than 35,000 average, well more than 10 times the normal volume. IV now at the highest level we had seen over the past year because of that big unusual option activity. Here was a look at the IV from that day. You can see the huge spike up, IV just shooting to the highest level, all because of the Iranian crisis, Strait of Hormuz, kind of fears, I guess, overblown as it ends up being, that shipments of chips with South Korea, Samsung, and SY Hynix, the two biggest components of the EWY, they comprise about 40% combined of the overall ETF, might have trouble with that. Hence, fear to the downside, especially. But we saw huge volume coming, and you can see from the previous day to March 4th that jump in IV. Taking a look at it over the past 20 days, we can see IV, which was hovering right around that kind of mid 45 to mid 50 level, right, had jumped now to the highest level we had seen. You can see the jump across the entire term structure vol. Taking a look at the chart, a 2-year chart, here is the basic 60-day, slightly out of the money call IV, by far the highest level. This is absolutely going parabolic. A shorter look, the 6-month one, absolutely doing the same thing. So this set up ideally for a vol capture trade to kind of lean neutrally, right? Not really taking a bullish or bearish view, more a straight vol sale here, but doing it in a hedge fashion as we always do. So went back to February 20th with the EWY at 135-ish, right? The 170 call, 100 put sell strangle, right? Which is equidistant, 35 points out of the money on both sides, was trading about $2.30. Fast forward to that day of that huge option volume, the EWY basically at about the same level, right? A touch lower, but that sell strangle, because of the huge jump in IV, now at more than double the price because that huge option volume lifted the IV in a massive fashion. So doing that quick comparative on February 20th, the EWY just over 135, that 100, 170 sell strangle, right? Trading at 230, 56 days expiration, IV at just over 50 on an average basis. Fast forward to the day of the trade idea video, right? We see the EWY basically at about the same price, a touch lower, 84 cents, right? But the self strangle more than doubling in price, even with 13 days passing, which should make option prices cheaper, especially these are not super long term. Why? Because of that massive spike in IV, up over 50% because of all that unusual option activity. So that's set up ideally for selling the 100 put and the 170 call. Fast forward to yesterday's close, we can see EWY basically hanging about the same level as well. So we got a, if you will, a little bit of break there, went down a touch, but certainly not egregiously. More importantly now, the IV has come down sharply, right? And that sell strangle, right, now trading at under 250 for a very nice profit. So taking a look at that trade, right, we put it on March 4th with the EWY at 134.37. On yesterday's close, it closed at 133.10. So down a little bit. The sell strangle back then on March 4th, 560, right? Yesterday's price, 245. So you could have made over $300 for each sell strangle just doing it one time, right? We did have a little time passing. Obviously, sell strangles, you do have a positive time decay working for you, especially when you get that jump in IV, you have more decay to head your way, right? You have more positive theta, and you can see IV came in over 7 vol points. Taking a look at that reversion, right? Here is where we put on the trade. You can see IV as expected, right? Finally coming in from Friday to Monday's close. We see IV dropping once again. Here's the day we put it on. Actually went up the following day. We didn't hit the absolute nuts high, but certainly within shouting distance. Now at under 62, able to sell it at over 75. Here's a quick look at that 60-day IV chart, right? Able to sell IV up here and then cover it, right, when it reverts. We're not looking for it to revert back to where it was before all the nonsense started. Just looking to take the trade off, or in this case, a very nice gain in a very neutral fashion, right, without too much of a margin requirement. So hopefully provides kind of the impetus between our trade idea generation, trade structuring, and so forth. And really, the main thing that we want to, do is you never want to go full retard. Use the Tropic Thunder line, right? You never want to, jump in. And when IV gets to this level, we always like to maybe take a position to absolutely take advantage of IV, but do it in a neutral fashion. So until next time, as always, here's the good.